Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing discount rate, how to calculate it very quickly. So to start off, what is the discount rate? The discount rate is the initial rate of return that you, the investor, are looking for. So if we take a company that's making hypothetically $100 million a year, and we were to say we're comfortable with an 8% discount rate, then what that means is that this $100 million that it's making per year only has to represent 8% of what we're going to pay for the whole company. So for an 8% discount rate, then that would value the entire company at 1.25 billion. So what the 8% discount rate means is that that 100 million only has to represent 8% of the total value of the company. If let's say we wanted an 11% discount rate for the same company making $100 million a year, then that would place the value of the company at only 909 million. The higher the discount rate, the less the company is worth. The lower the discount rate, the more the company is worth. Because let's say if we have a 6% discount rate, then that means that whatever the company is making is only representing 6% of what we think it's worth. So if a company is making 100 million a year and we have a 10% discount rate, then we're saying that company is worth $1 billion because that 100 million that it's making is only worth 10% of what the company's worth. So the lower the discount rate, the more the company's worth. Again, let's say a company's making 100 million a year and we have a 5% discount rate, then we're saying that the company is worth 2 billion, or that 100 million is only that it's making on average year after year is only 5% of what the company's worth. For higher risk companies, you're going to want a higher discount rate. For lower risk companies, you're going to want a lower discount rate. How do we choose a discount rate? It all comes down to interest rates and bond yields. If bonds are yielding like they are now, AAA bonds, somewhere between 4 and 5% roughly, we're going to want our equities to yield at least 2 percentage points higher than that, generally speaking. If you go back, a year or 2 years ago where bonds were yielding 2 or 3%, then the minimum discount rate that we're going to be comfortable using on our equities is going to be somewhere between 4 and 5% at a very minimum, okay? And that would be for an extraordinarily safe company. And even that is quite low. There's basically no scenario, or it would be extremely rare scenario where equities, the minimum discount rate would be lower than 6% or 5%. If we look at the current market with bonds yielding somewhere like 4.5 or 5%, our discount rate is probably going to be a minimum of 7%. And even that, when I say minimum, I'm talking absolute minimum in the safest industry with the safest company with the lowest debt possible. How do we find the upper end of our possible discount rates? In reality, there's no upper end. And when it comes down to these things, keep in mind, these are just general rules. To calculate the discount rate, there's only one thing required: your brain. There's very few other numbers that you really need to plug into some sort of formula. The discount rate is qualitative and not quantitative. What do I mean? Once you understand a particular industry and a particular company and its dynamics and its relationship to an industry, you can choose a discount rate that you believe is appropriate for that particular company. But you have to understand the business first before you choose a discount rate. You can't plug things into some calculator to come out with the discount rate. It has to be quantitative, not qualitative. Because ultimately the discount rate is what you, the investor, are comfortable with being your initial rate of return. If a company is making $100 million a year sustainably, let's say, it's ultimately up to you, the investor, and no one else, no formula and no calculator, to determine what rate of return you're comfortable with that 100 million representing in your first year of ownership. If you think it's a very safe industry, a very safe company with low debt and growing margins and high returns on capital, maybe an 8% discount rate you're perfectly fine with, right? But if it's a high debt company in a risky industry with lots of change and mediocre returns on capital, maybe you're looking for a 13% discount rate. The point is that there's no secret to this. Generally speaking, your discount rate is going to range somewhere between 8% on the very low side in the current environment, all the way up to probably 13 or 14% on the high side in risky industries, with fluctuating free cash flows and high amounts of capital investment required and high levels of debt. So that's something to keep in mind. I don't believe in using weighted average cost of capital. I don't believe in using any sort of fancy formulas. I think you got to pick a number for yourself, what you're comfortable with based on your understanding of the business. To put in perspective, a company like Ulta Beauty here, I mean, I'm very comfortable using a 9% discount rate for a company like this, even an 8% discount rate. And you'll see that once you determine the current sustainable levels of free cash flows, like in this case, 774 million. Once you pick a discount rate, like let's say I'm comfortable with 8%, and I value the franchise somewhere around 10 billion. Even if I'm off by my cost of capital by as much as 1% in the other direction, it's not going to really matter. So even if, let's say, I choose instead to have like I just said 8%, but let's say it's a 9% cost of capital, I mean, the value of the business is not going to vary tremendously because my margin of safety required is going to be at least 40 or 50% anyways. So even if I'm off by 1 percentage point in either direction, it's not going to make a big difference. And that's the reason why, you can't really calculate the cost of capital any more precise than an entire percentage point. So for people that are trying to calculate a cost of capital all the way down to the second decimal place, I think it's kind of redundant. For me to pick a cost of capital, once I understand the business, takes me about 3 seconds. I'm not really debating because I know roughly what range it's going to be in anyways. I can make cases for it being 8% or 9%, but for a company like Ulta Beauty, if you're using a 13% cost of capital, it would just be absolutely ridiculous. So, there's a range of reasonableness for your cost of capital, and ultimately it's going to come down to what you, the investor, are comfortable with. And the things to pay attention to is how much debt does the company have, what's the sustainability of the industry, like in terms of is it fast changing? I mean, Ulta Beauty is a makeup company. It's not going to be changing like semiconductors or medical products and so on. So it all depends on the industry and the levels of debt and so on, and the company's position within the industry and so on. So my key takeaway from this video is you choose your cost of capital, not a calculator. And your cost of capital in the current environment, like I say, is going to go somewhere between probably 7 on the low side, all the way up to 14% on the extremely high side. And it's up to you what you want to choose in terms of your numbers. If the company is low debt in a great industry with high margins, growing revenues, and high returns on capital, and so on, and you understand the business well, then you might be comfortable with a lower cost of capital. For companies that are in a rapidly changing environment with high levels of debt, maybe you're going to want to use an 11 or 12% cost of capital, or even 13%. Maybe so keep that in mind when choosing your cost of capital for the company. Remember, it's not about a formula, it's about using your brain and being qualitative. I hope you enjoyed the video. If you have any questions, please feel free to ask in the comment section down below. Thanks.